Backtesting is a fundamental concept in systematic trading. It is the process of testing a trading idea on historical data. Imagine you have a new strategy you believe will be profitable. Instead of risking real money immediately, you can simulate it. You apply your trading rules to past market prices. This shows you how the strategy would have performed. It is like having a time machine for your trading ideas. You get to see the potential outcomes without any of the real-world financial risk. This is not just a suggestion, it is a necessity for any serious trader. The importance of this process cannot be overstated. The markets are filled with emotions and gut feelings. Backtesting replaces these with cold, hard data. It provides objective evidence about a strategy's viability. Does your idea have a statistical edge, or was it just a lucky guess? A proper backtest will reveal the truth. It helps you understand the character of a strategy. You will see its potential profits, its likely losses, and its overall risk profile. This knowledge builds confidence and discipline, two critical traits for long-term success in the markets. Without backtesting, you are essentially flying blind. Many promising ideas fail when put to the test. A strategy that sounds brilliant in theory might perform poorly in reality. Market conditions change, and what works in one period may not work in another. By testing across different historical periods, you can uncover weaknesses. You can see how your strategy behaves during market crashes, bull runs, and sideways grinds. This rigorous examination separates professional quants from hopeful amateurs. It is the first step towards building a robust trading system that can weather different market environments. So what does a good backtest tell you? It provides key performance metrics. You will learn about the total return, of course, but you will also see the maximum drawdown, which is the largest peak to trough decline. This tells you how much capital you could have lost. You will see the Sharpe ratio, which measures risk-adjusted return. You will understand the frequency of trades and the average profit per trade. These details paint a complete picture. They allow you to compare different strategies on a level playing field and choose the one that best fits your risk tolerance and financial goals. Python has become the language of choice for quantitative analysis. Its power lies in its simplicity and a vast ecosystem of specialized libraries. For backtesting, a few key libraries stand out as essential tools. The most fundamental is Pandas. It is not a backtesting library itself. Instead, it is the workhorse for data manipulation. You use Pandas to load, clean, and organize historical price data. Think of it as the foundation upon which you build everything else. Its data frame structure is perfect for handling time series data like daily stock prices or hourly currency rates. Once your data is prepared, you need a framework to run the simulation. This is where dedicated backtesting libraries come in. One popular choice is BackTrader. It is known for its clean structure and extensive features. BackTrader provides all the necessary components out of the box. It has a main engine called a Cerebro that runs the simulation. It handles data feeds, strategy logic, brokers, and analyzes. This allows you to focus purely on writing your trading rules. The library is well documented and has a strong community, making it a great starting point for beginners who want a comprehensive tool. Another powerful library is Zipline. It was originally developed by Quantopian, a platform for algorithmic trading. Zipline is built for rigor and is particularly strong in handling complex issues. It helps with things like survivor bias and point-in-time data. This makes your backtests more realistic and scientifically sound. While Quantopian's platform is no longer active, Zipline continues as an open-source project. It is a bit more complex than BackTrader, but its focus on accuracy makes it a favorite among serious quants. It integrates well with the broader Python scientific stack, including Pandas and NumPy. Choosing the right library depends on your needs. For simple strategies and learning the basics, Pandas combined with some custom code can be enough. This approach gives you maximum control. For more complex systems, a full-featured framework like BackTrader is ideal. It saves you from reinventing the wheel. You do not have to write code for order management or performance calculation. Zipline is for those who need institutional-grade accuracy. No matter the choice, mastering these tools is a key step. They provide the engine that turns your trading ideas into testable hypotheses. Let's walk through the basic steps of a backtest. The process can be broken down into a few logical parts. First, you need data. You can get historical price data from various sources, like Yahoo Finance. Using Pandas, you can load this data into a data frame with just one line of code. This data frame will typically have columns for the date, open, high, low, close, and volume. This is your raw material. It is the historical reality against which you will test your hypothesis. Make sure your data is clean and free of errors before you proceed. Next, you need to define your trading rule. This is the heart of your strategy. Let's use a very simple example: a moving average crossover. The rule could be, buy when the 50-day moving average crosses above the 200-day moving average. Sell when it crosses below. Using Pandas, you can easily calculate these moving averages and add them as new columns to your data frame. Then, you write a simple loop or use vectorization to create trading signals. A 1 might represent a buy signal, a -1 a sell signal, and a 0 means hold. With your signals ready, it is time to run the simulation. This is where you calculate the performance. You iterate through your data day by day. When you see a buy signal, you simulate buying the asset. When you see a sell signal, you simulate selling it. You need to keep track of your portfolio's value over time. This creates what is known as an equity curve. You must also account for practical details. This includes transaction costs and slippage, which is the difference between the expected price and the actual price of a trade. Ignoring these can make a strategy look better than it is. Finally, you analyze the results. Once the simulation is complete, you will have a series of trades and a final portfolio value. From this, you calculate the key metrics we discussed earlier. What was the total return? What was the maximum drawdown? How many trades were made? What was the win rate? Libraries like BackTrader automate this step. They generate detailed reports with all these statistics. This objective analysis tells you whether your simple moving average crossover strategy was profitable during the historical period you tested. This is the moment of truth for your idea. The results of a backtest are not just numbers on a screen. They are a guide for improvement. A failing strategy is not a total loss. It is a learning opportunity. Perhaps your moving average crossover system performed poorly. The data might show it generated too many false signals, leading to high transaction costs. This insight is valuable. You can now go back and refine your rules. Maybe you need to use longer moving averages. Or perhaps you should add another filter, like a volatility indicator, to confirm the signals. Backtesting allows for this iterative process of refinement. Analyzing the equity curve is also crucial. A strategy might be profitable overall, but its equity curve could be very volatile. It might have long periods of underperformance, known as drawdowns. Looking at the timing of these drawdowns is important. Did they happen during specific market conditions like a crash? If so, your strategy might be vulnerable to certain environments. This knowledge helps you manage risk. You might decide to reduce your position size or even turn the strategy off during those conditions. The backtest gives you a roadmap of your strategy's behavior. Furthermore, backtesting helps you avoid common psychological traps. One of these is curve fitting or overfitting. This happens when you tweak a strategy so much that it perfectly fits the historical data. It looks amazing in the backtest but fails in live trading because it was tailored to past noise, not a real edge. A good practice is to test your strategy on out-of-sample data. This means you build the strategy on one period of data and then test it on a different period it has never seen before. This helps confirm that your strategy is robust and not just a product of overfitting. In conclusion, backtesting is your laboratory for financial markets. It is an indispensable tool for developing and validating trading strategies. It moves you from hopeful guessing to data-driven decision-making. Start simple. Use Python and its powerful libraries to test basic ideas. Learn from the results, both good and bad. Do not be discouraged by initial failures. Every failed backtest teaches you something important about the markets. With patience and rigor, you can use this process to build a trading approach that is logical, tested, and tailored to you. The journey begins with that first line of code.